Yeah, good morning, Ben. Really nice to be here with you. So, a couple things. Crude oil, I think it would be a surprise to anybody, to most market participants. It would be a surprise for crude to somehow end up back down into the crater. Thank you.
Yeah.
Into the 50s. That was a great choice of words. Into the $53, $54 range. I'm not saying that that's impossible. It's not part of our forecast to say that that's going to happen. But I do want to make it clear that there are certain things that if crude were to do, it would signal a dramatic decline. So kind of one of those things for us is if we were to move in crude oil, like having a weekly or monthly close below $69. We still think that $70 to $69 level is really important. We all want to get our paychecks and be paid on time, and there is a labor component to this. But purely from the technical standpoint, as long as we continue to close weekly and particularly monthly above $69, we think crude oil is in a very strong position and actually would end up moving back up to the $90 to $91 level in the second half of 2024.
Second half of the year, hold above 69.70. You think we could see 91 again? Talk to us about if we do take out 69, again, not necessarily expected to crater down to 50, to your point, my word, your point. Talk to me, what are the levels that we find support here? Should we find our way, again, lower below 69?
Well, you would end up in our work, especially if it happens in the second half of the year. We use time a lot in our forecasting. In the second half of the year, if it happens, it would be $54 to $53.
Okay, so maybe it would get that 50 level.
Yes. Yeah. No, we definitely believe that if we break 69 and really have a significant close below it, we're going to have to see $54 to $53. One other thing I want to say on the upside, let's just go back to the upside for a moment. For us, the normal position for the market is to continue to close above $69, and the surprise is a monthly close below it. One other piece of our upside is that once the market would reach $90 to $91 in the second half, and perhaps as early as the third quarter, which is in the second half, but the first half of the second half, if crude started to show strength above $92, at that time in the second half of the year, there would probably be a flash spike up to 101 to 102. So we would actually have tremendously high crude oil prices under this scenario right as the election was happening. And in many cases, an election year, as you so well know, is a year where they're going to make it as pretty as they can. So there is a possibility that we have that break to the downside, but that's not really what we're calling for.
Yeah, unusual catalyst, right? I guess is the best way of kind of categorizing what we could see throughout the election year, and maybe one would argue already have seen. In terms of a surprise to the downside, I'm sort of wondering with the ECB today, the Bank of Canada cutting yesterday, the Fed sort of next in line to punch that card ultimately. I mean, do we have a potential to see some weakening economy start to weigh on crude prices here, and maybe sort of lack of enthusiasm for China for that matter?
Oh, a number of those things would all come into play. First of all, the Fed interest rate cut, which I think is expected in September, is one of the factors. Interest rates and crude oil prices are very important together. Obviously, a lowered, for your listeners, and I know most of them know this, a lowered interest rate is going to spur the economy on. Spurring the economy on is going to produce the use of crude oil. So the interest rate issue is big. And even if he just cuts, and probably will be a quarter point or a very small cut, it's a signal to investors and to people that, better times are coming. It doesn't have to be a really big cut. It has to simply be a cut in order to get people excited about it. People will think and create a whole world in front of them just with a quarter point cut. It'll really change. You know how people do that. So, it's just the way things work. So even if he only does a quarter point cut, we're pretty sure that's going to be pretty good. And one other thing about interest rates, if you don't mind, if I just throw this in.
Not at all. Go ahead.
With the bond market, which is obviously related to interest rates, and we're talking about the 30-year U.S. Treasury bond, our forecast for this whole year has been that the bond market is going to be trading in 2025 at 136 to 137. It's quite a bit higher than where it is now. And so this initial rally that we've just seen up here, we think this may be just the bare beginning of that. We have a lot of time to get into 2025. But if you think in terms of longer term, the interest rates, it looks pretty good for 2025 with the idea that the bond market would be back up at 136. We could have a pretty good little thing going for a while in 2025 because of interest rates being lower. And I have to assume that with the bond market at 136, we would have seen several cuts by that time.
Well, it'll be interesting to watch. If we do see yields come off to that point, will that spark some demand for crude oil ultimately, or will it be tied to a weaker economy? And will that, will we see that in terms of lower prices? David, appreciate you joining us here, giving us something to look forward to as we head into the second half of the year, a couple key levels to look at on the bigger picture.